This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Welcome to Breaking Banks Europe, the show that brings you news from around the continent on all the latest fintech news, companies, investors, and more. I'm delighted to welcome a very special group of guests today to discuss, quote, news from the FinTech Front. Makes it sound very serious. I'm joined today by guests Dr.Ruth Wandhöfer, Dr.Leda Glyptis, and the wonderful Nasir Zubairi. Ruth, thank you so much for joining us today. Why don't you tell our audience a little bit about yourself and what you've been working on lately?
Great pleasure to be on the show, everyone. Good morning. Yes, I've been sort of over a decade a banker in Citigroup. I've spent a year and a half on the board of LSE Group. I'm on the board of an Irish bank. I'm on the board of Gresham Technologies, which is a UK-listed tech firm. And I'm also on the board of a smaller digital identity firm that tries to work on the basis of open banking. And next to that, I consult various fintechs, and I'm also a partner at Gauss Ventures. So it's never boring, and it's all about connecting the dots. Thank you.
Love that. Lots on your plate. Leda, a bit about yourself. I think we have some exciting news as well.
Yeah, we do. Fresh out of the press. First of all, let me say that when I saw who was on this show, it felt a bit like a family reunion. It's really nice to see you, but it really sort of stresses this COVID-related absence, because they would have been hugs otherwise, Naz. You would have loved that. I'm Leda Glyptis. I am a recovering banker. I guess is the most precise way of describing myself and my life. I've spent the last 2 decades in banking technology, the last few years outside banks, selling into banks. I'm on the board of a few startups around the ecosystem, slightly different stages of life, but all trying to solve problems of actual user segments of the market by the creative application of technology. And as of today, I'm joining 10X as their chief client officer. And I'm very excited about this new journey. It's literally like it's been public for 7 minutes.
Yes, you heard it here first. It's the scoop of the day. Amazing. Well, thank you so much for being with us today, Leda. And last but certainly not least, Nasir, a bit about yourself. And do we prefer Naz?
Naz is probably easiest.
Naz.
That's my name correctly in 45 years of my life, apart from my parents. I must confess, thank you very much for having me on the show, Nina. I feel very inferior because I don't have the title of doctor before my name, unlike the other 2 esteemed guests here.
You and me both. Yes, we're working on it.
There's an ambition now for the future. I need to get that doctorate somewhere. I've spent a couple of decades working in financial services. Most of my career was in banking. So I was capital markets, but for the past 10 or so years, 12 years, I've been in fintech. Started off building businesses. The last set, most prominently, were in Germany with Finleap, so launching Solaris Bank, launching Clark, and a few other businesses around that area. And I've been in Luxembourg for the past 5 years running something called the Luxembourg House of Financial Technology, which is a public-private foundation, so not-for-profit, set up principally by the government. I have the Minister of Finance as my chairman and various other dignitaries from public bodies, as well as 13 CEOs and MDs from financial sector companies, who we all sort of try and drive the adoption of digital finance in the Luxembourg Financial Centre, which as of December 31st becomes the largest finance centre in the EU.
You had to go there. You had to.
I had to.
Well, that leads us perfectly into our first topic today. I will admit to the audience that I was very, very excited to have this particular group of people here, much smarter than me, to comment on things that have been swirling around my brain recently. The first of which is, unfortunately, Brexit. So, largely, I've been thinking quite a bit about this and what exactly does this Brexit impending due date mean for us here, well, those of us based in the UK. We've seen Curve recently apply for a regulatory license in Lithuania. Modular was recently granted an e-money license in Ireland. And even Revolut, FinTech darling, is seeking an e-money license in Ireland, despite its backup license in Lithuania. So to date, London has really taken an outsized role in European fintech, depending on who you speak to. But Brexit abruptly removes many of the existing advantages. So what I was thinking about and pondering is this an opportunity for Europe to domesticate and invigorate their fintech ecosystems? And who better to speak to and ask that than maybe Naz to start?
Okay. Domesticate. I'm not quite sure what that means. I think, look, Brexit is a lose situation for the UK, no matter what. I am still a proud Brit, not proud of Brexit in any way, but I sit in the heart of Europe in an alternative finance centre, one that continues to support the UK and will continue to support the UK post-Brexit. Because of the intertwined web of financial services. But the big problem with Brexit ultimately, I think, boils down to sort of three core areas. One is critically, obviously, regulation. Second is talent. And three is customer base, right? Look, firms that are unregulated will continue to do good business being based in the UK. They don't need a license to go and sell their products to other businesses outside of the UK. It's really a case of just being able to connect with them and find the right partners. However, with Brexit, a lot of the UK traditional financial institutions have set up shop or augmented their operations in various other centres. Luxembourg and Ireland were clearly the two big winners out of that, particularly in asset management, insurance, private bank and private equity as well, actually. So the customer sort of decision makers, that kind of paradigm has shifted a little bit. Now, that was never easy in the UK anyway, because you're dealing with these giant institutions with layers upon layers of staff and finding the right decision maker to make purchasing decisions, procurement decisions for an institution was always a bit tricky, and you had prolonged sort of sales cycles, 2.5, 3 years, 4 years in some cases. And that tends to be a lot easier on the continent anyway, because you're dealing with smaller operating units and you're able to get to those decision makers quicker. And I think a lot of firms, because they've had to explore options as a result of Brexit, have seen, wow, we can maybe do easier and faster business on the continent. The bigger problem, I think, for UK, I don't see any massive change in UK fintech, but the big problem over time with talent, right? Where do the developers come from? They come from all over Europe. The UK is not in itself a powerhouse of technology education and technology skill set. We look across Europe. There are other centres, particularly, let's say, Eastern Europe, where we see huge talent pools and low-cost talent pools for tech talent that had been migrating to the UK to be part of that centre. They can't do that anymore, right? And that's where a big problem will be. A lot of Europe as well has put a big emphasis on sort of more global talent pools as well. For example, Luxembourg is wooing the Indian talent pool in tech, right? Because now, again, where you're looking at big businesses moving their operations, setting up across Europe, traditional migrant populations that would always look to the UK performers feel welcome there anymore. And are looking at other alternatives. So over time, that's going to be a huge issue. I guess also, from the licensing perspective, obviously, yes, everyone needs to get a license to operate within the European Union. 60 million customers in the UK, or the potential of 60 million customers, is fantastic, but that's not going to scale and make a unicorn fintech company, right? If you're in the B2C area, you need to operate in 450, 500 million customer base, which is the European Union. And as you've seen, many of the businesses that were pan-European have applied for their licenses across Europe. We've had many come here and set up payment operations in Luxembourg. I think the question becomes, sorry, not the question, but what's been interesting is the panic we've seen from fairly sizable payment institutes, the vast majority of the regulated entities, who hadn't planned at all for Brexit. There are going to be a vast number of PIs and EMIs that are going to cease operations on December 31st. It's that simple. Now, they might be able to get quick file licenses in Lithuania or somewhere, but those licenses, are coming under increasing scrutiny from the European regulators, because there's no way you can grant a payments license in a month. You can't do due diligence effectively. And there's a large number of firms in the UK that are going to get into trouble on December 31st. So they're going to have to scale down their operations. Revolut, have done a two-tier system. They've applied for a temporary license. Lithuania, looking for a long-term one in Ireland. Ultimately, the Lithuanian license isn't really holding up water, because Lithuania just simply doesn't have the skill set to manage that regulatory of a payment institution license to the effectiveness of, say, an Ireland, a Germany, a Paris, or Luxembourg can. So there will be problems. They're not going to be necessarily immediate and hugely impactful, but over the long term, yes. But there's similar problems across many industries.
Yes, I think before we started speaking, Leda, you also expressed a bit of frustration at the current situation and maybe how little attention is being given to Brexit. Did you want to?
Yeah, we almost forgot it was happening. Well, I'm in a sort of symmetrical and opposite situation to Naz, in that I am a non-Brit living in Britain. So obviously this situation has felt very personal. But from a practical point of view, I agree with what Naz has been saying. And I think what we're seeing coming out of it is it's neither as simple nor as clear cut as this being a zero-sum loss for one side of the equation, win for the other. And I do think that there is a situation where, just to extrapolate on a couple of the points that Naz was making, there is a bit of a lose-lose, and that lose-lose is carried by the humans, particularly the thing that flies under the rubric talent, and quite a lot of companies that were not necessarily solvent enough to prepare for every eventuality. Because I think we often talk about the UK ecosystem being unique, and that is absolutely true. And its uniqueness is appealing, and although it will be affected and in many ways damaged by Brexit, it won't entirely go away. And equally, it won't be a sort of ipso facto creation of an alternative ecosystem somewhere else. So I think it's fair to say that Brexit challenges a lot of what we have that has made this such a vibrant place, but it doesn't remove all of it. And equally, Brexit doesn't create a guarantee of success anywhere else. A lot of the relationships continue to exist. But to Naz's point, we have had a protracted period of insecurity, which has been the biggest problem that Brexit has brought, leaving aside our own personal politics and preferences, and the fact that open is generally better than closed for commerce and financial activity, human rights and human evolution, right? So parking that for a second, from a purely macroeconomic perspective, the worst thing about Brexit, irrespective of whether you voted for or against it, is the protracted period of insecurity, a period of insecurity that was brought about by some events outside people's controls. COVID didn't help, but quite a lot of it brought about by events entirely in people's controls and sort of micro-political concerns that left big organizations running 2 or 3 scenario teams, spending a lot of time and energy in scenario planning for what they could and should be doing. A lot of big banks having relocated both books of business and entire teams to areas where jurisdictionally the regulation won't shift. And a lot of startups that didn't have the option to do so, as Naz quite rightly pointed out, the ones that were solvent enough to create optionality for themselves did. But I think the first thing we can absolutely say is that it has been absolutely damaging, and we will feel the long-term damage of this insecurity and uncertainty. And let's face it, a no-deal Brexit is not good for any of us. It's not good for us as individuals. It's not good for the economy. It's not good for access to anything. But it's definitely not ending that period of insecurity. And all of the scenarios that Naz described are not, they're not even an if case, right? They're happening, they will be happening. And if you are faced with a situation where you have to make some immediate choices, either as a talented engineer, as an investor, or as a startup, you won't sit on your hands for the next 6 to 12 months while this thing is played out. And of course, COVID creates an extra layer of insecurity and uncertainty, which means that if you have to make choices, where should I move? Where should I put my money? You're going to make the choices that seem to carry the least risk, because that's the sensible thing to do. And Brexit is really not helping us. I'm going to breathe now.
I think, Naz, you had one last point you wanted to share.
Yeah, one other major issue, which may turn into a major issue, although opportunities may arise on the flip side from the US. But you need to look at all the venture right across which is principally based out of the UK. If you look at the list of LPs for nearly pretty much every major VC fund, you see the EIF. Now, getting funding from the EIF as a limited partner requires a tailored approach in terms of a percentage of that investment going to European Union firms. And the UK is no longer part of the European Union. Therefore, there will be an impact on funding. We've seen many of those VCs setting up operations in the European Union, in the continental European Union, or what will be the European Union, because they need to continue to get access to the EIF funding. I mean, they're one of the biggest, if not the biggest, well, they're the biggest LP in Europe by a long, long way, right? And you have to, the criteria is that investments need to go into European Union startups. And the UK will no longer be part of that box, so to speak.
Well, on that note...
So even if it's 66% European Union, there's a problem.
Yeah, absolutely. On that note, perhaps something a bit more positive. Turning to open banking, and something that we've all been following and discussing in our private bubbles and group chats. It's been argued that open banking was a gift, perhaps, from the European Commission vis-a-vis PSD2. In the UK, I was recently speaking to a friend who said we've kind of been building off each other. In the UK, we took it a step further by adopting a technical standard set by the OBIE and CMA. This, in turn, was received by the Australians and Brazilians who improved on that standard. For example, in Australia, their mandate actually includes loans, mortgages, and term deposits. And then with the recent consultation around variable recurring payments and sweeping, it's clear that open banking does evolve cumulatively. In the UK, it seems that we're running at about a 2-year cadence. So we had the original open banking consultation in 2016, if I'm correct. Then the first account-to-account payment initiated with Token and Santander in 2018. And now the introduction of variable recurring payments and sweeping consultation this year. What I would love to hear is a bit about the view from the continent and what the cadence is on the continent of open banking development in Europe. Perhaps the best person to speak to might be to first chat to Ruth. What are your thoughts on that, Ruth?
Yeah, this is a really good question, and it sort of sequences nicely from what we previously talked about also in the context of Brexit, just keeping in mind the number of electronic money institutions and payment institutions that have been licensed in the UK, pretty much all of them. And of course, that means you're almost shifting a whole market potentially over if you think about the customer base. But we have to remember the European open banking is very much anchored in legislation, in PSD2 primarily, whilst the UK took the angle from a competition perspective with CMA 9 and then said, look, to open up the market, we have to be much more hands-on. It can't be just policy wordings that are implemented in slightly different ways and different interpretations. It has to be a lot more standardized. We have to have a middle layer of standards and technical implementations that really allows complete openness for these sort of instruments. And as you just referenced, it is moving from open payments, open banking to open finance more largely. And the EU is actually trying to now mimic this. But again, the cadence will be obviously more subsequent. So at the moment, the situation is that Europeans are still struggling in terms of PSD2 with the quality of the bank APIs. Everyone agreed as part of PSD2 to bring in the new players over time in a more secure way using application programming interfaces and handshakes between third parties and banks so that everyone knows that with customer consent, someone is accessing your data as opposed to the sort of traditional initial way of doing it via screen scraping. So people are still struggling with that because they didn't have an OBIE, they didn't have a standard setter that would say this is exactly what the API has to include, this is what people have to implement. There have been working groups at the level of the European Retail Payments Board, which actually came out with a list of attributes to be in the API to allow for the existing business models of third parties such as Klarna and Trustly to work effectively also in the new world, which was moving from direct access, as they call it, to APIs. But none of this, even though it was agreed at a high level, none of this was ever implemented. So you literally have a situation where in some instances, a third-party provider under PSD2 doesn't even get the account details or the right sort of minimum data set from the bank in order to continue to produce the minimum service level that the customer was used to. And I think what we're seeing here is that there are two different worlds really that are coming out here. One world is those third-party payment providers that existed before PSD2 was designed and approved, which were more the direct access players. And then there was a whole raft of providers that basically set up shop after PSD2 was agreed, keeping therefore in mind the API only focus and basically working primarily from the UK open banking API perspective, because that was the only one that was clearly defined and clearly implemented. And so this leads also to tensions across the market. Third-party providers from the UK trying to offer services in Europe. Sometimes the data set isn't the right one because there's no standard. Equally, the Europeans are very much trying to expand beyond their countries nationally, but they see the API environment completely different in different countries. And some countries are so behind, the banks really haven't done their homework. So there is still this teething problem. And as we know, even though PSD2 applies since 2018, we still have issues with secure customer authentication. We've seen new implementations with additional friction. So we are not at an ideal point. And the big loss is really that we don't have that standards layer across Europe. That, of course, now in a Brexit context also means that you will increasingly be serving one consistent market and one fragmented market unless people step in to provide more standards. And I think one thing I was reflecting on that Nas said was actually the customer base. I agree on the talent points. And I think with COVID, we moved into remote working. So you might get talents from all around the world for your businesses. That may not be the biggest issue, but I think one question is customer base. And of course, the majority of individuals, humans, literally live in the EU because it's a much bigger market. So thinking about it from that perspective tells you what thing needs to happen if fintech that sort of grew up in the UK wants to continue to be meaningful for the European market. And I hope that our government doesn't see fintech as a luxury, but as a national asset. And our government, I mean the UK, even though I'm also not a UK passport holder, but I have a settlement agreement, so that should keep me afloat for a while.
Yeah, I have one of those. It comes with bold letters at the bottom saying, this can be revoked at any time with no warning.
Yeah, and
don't get comfortable, foreigner.
Yeah, the personal side is indeed quite hurtful, but let's move that to the side. Yeah,
it's quite interesting to see how two non-Brits are the ones broadcasting from the UK, and I, as the only Brit, am sitting here in Luxembourg.
Three non-Brits. Ballerina isn't a Brit either, or have you applied for?
No, I'm an American.
Yes, all in the UK. I'm the one aboard.
I'm living on borrowed time.
Yeah, you Brexited faster than anyone else now.
You already have your license agreed, so you're safe.
They might march you back. It's like, this will teach you. What I find very interesting about open banking, and I've used a dramatic metaphor before, and I'll use it again. It's like when it was presented as a regulatory framework, I was still working inside the bank. It was as I'm sure you guys remember, it was a regulatory project. And sometimes people from channels would come in and go, we should probably be able to use this. And then everyone would look at each other, spend some money on some very expensive consultants. And some creativity was shown around open banking, but it was limited. And it was limited for many reasons. And one is that you don't get inspiration by staring at something. But equally, it's almost like saying, gravity must be good at something, and by staring at gravity you come up with dancing or seesaws. It doesn't work that way. The creativity comes sideways, and open banking as a framework is available for the execution of an idea that wouldn't be viable otherwise. And for me, it's always the stuff we don't know we lost that is the most painful, and we will never know what it is. But that combination of the two topics we've touched on so far, and the expose that both Ruth and Naz put forward, leaves us with that gap. As Ruth pointed out, if we don't know how this will affect us here in the UK, that creativity as the framework and the regulatory provisions are maturing is coming to the fore, both in the UK and the EU. But as this thing might be pulled out from under our feet, you will see the smaller organizations that are coming in to use it, not using it because they were incumbents, moving their business to somewhere where the fundamental plumbing works, or not going down that creativity path because it might not be available. And again, it's that gap that says, let it bed in, and then the amazing things will happen laterally.
And maybe just one point to add. Again, coming back to the motivation, in the UK, it was about competition. The big banks have too much concentration in the retail space. Whilst in Europe, it was also about competition, but like making the European fintech market, allowing it to strive. And that, unfortunately, that narrative has shifted as well, as the Asian and American competitors in the big tech world are increasingly challenging the banks' businesses overall. And there is a feeling that the European regulators are actually starting to protect the banks, the incumbents, from any other competition, because the big techs are already such a big threat. So rather than saying develop and strive third-party EMIs, payment institutions and banks together to create better solutions and collaborate, they're actually now saying, oh, it's okay if the banks don't have the right APIs. Let's make sure they don't get any other competitive threats because already US and Asia is there. And I think that is a fundamental flaw, because it doesn't build on the creativity and growth potential. Never mind Brexit or not, if you just see it as a market, I think there's a lot more opportunity to create fintech for Europe plus UK to have a bit of a weight against the US and Asia.
Amazing. On that note, we're going to have to go to a break, sadly, but stay with us, audience, and we'll be back with more.
Do you want to be part of Breaking Banks Europe? Reach out and learn more about the opportunity to be featured in one of our shows. With over 1.6 million listeners and counting, Breaking Banks Europe is bound to become the place to advance critical dialogue in Europe and the UK fintech scene. Reach out on Instagram or Twitter at Breaking Banks EU, or go to www.provoke.fm.
Welcome back, Breaking Banks Europe audience. We've been having a very wonderful conversation right now about Brexit and open banking. we're hitting that bingo card of all the buzzwords, it feels like. And therefore, we could not, we'd be remiss to not speak about CBDCs. So I feel like a conspiracy theorist when I bring this up, but it's something in the past month plus the past week, a lot of things have been coming out, which when you add them together, seem, in my opinion, to point to a certain direction. But I wanted to get the opinions of our wonderful guest today. So, Yanis Varoufakis, have I said that correctly?
You have.
Amazing. Yes, that Yanis recently wrote a piece in Wired in which he asserts that the Bank of England should be providing free accounts. Last month, HSBC announced that they may start charging for current accounts, and I'd imagine that many high street banks have also come to this conclusion. Realistically speaking, net interest margin has probably dropped to nothing for banks. They are inefficient, bloated. It costs, £50 to service an individual account, maybe? Then, seemingly unrelatedly, John Cunliffe, the Deputy Governor of the Bank of England, recently stated, "Our job is not to protect bank business models. Banks will have to adjust. Our job is to ensure that if bank business models change, we manage the financial and macroeconomic consequences when it came to protecting banks against digital currencies." Given Yanis's piece, if the Bank of England were to offer a completely basic account, that is money in, money out at a base rate, a debit card, would that then not be considered an intermediary step before a CBDC? So I wanted to get your opinions on this. And Leda, as our Greek correspondent,
Your resident Greek.
I thought I would go to you first.
Well, let me start by saying that Yanis Varoufakis seems to have made his business to be controversial these days, right? So anything he says, despite his expertise in the space, has to be taken into account that his persona and voice has been that of a troublemaker, and this one was not as controversial as I have come to expect, to be honest. For me, so let me say three things that sound unrelated but kind of weave together. One is that there is something profoundly unexciting about the way the central banks themselves choose to talk about the possibility of digitalizing the currency. And I find that really counterintuitive, because they seem, and particularly those of us who spend a lot of time listening to their announcements around CBDCs, they seem to be pushing you down a payments route. And that's not where I want you to push me, because that's not what we're talking about here, right? The payments piece is done. We've got the infrastructure for that. This is not what will be fundamentally transformed. I want to hear about money supply. I want to hear about monetary policy. I want to hear about closed circuit currencies. I want to hear about programmable money, and I want to hear about permissions and liberties. So the focus of the conversation on feasibility, to me, is not relevant. It's feasible. It's doable. In fact, it's happening, right? The digital yuan is something that is coming our way. The cost of doing business, I kind of agree that theoretically the central bank isn't there to make sure that bank business models work. But also, what are they there for? In the sense that central banks started life to fund, wars for royal houses, and have evolved into what we have come to respect now, that is very closely tied to a set of business rails, right? This is how it operates. So that's the second piece, that if we're moving into a world of programmable money, then is the central bank going to evolve into the entity that is hand in glove with the regulator on what that is allowed to do and what our liberties, et cetera, are. And then the third piece is understanding not the technical implications or the financial implications or the cost implications, but the civic implications of doing something like that. And to me, these are the three building blocks that are conveniently absent from the statements that are coming at us down the pipe. And I say conveniently because we don't have answers yet, right?
to complement the views, I mean, this has been a topic I've been literally researching on for years. Right. One of my PhD papers was about creating a digital euro and a framework to doing that in 2017. And we very recently have seen the ECB issue presentations around should we do a digital euro, consulting the market and saying that maybe by mid next year they take a decision as to whether they want to pursue something along those lines and test it. I agree with Leda. It's not about payments. It's not about technical feasibility around distribution. It's also not necessarily about the technical platform in terms of lots of choice being out there. The big question is really what happens to the commercial banking sector. 90% of money is commercial money today. That comes into being via credit creation. If the central bank, which is really not a retail bank and not very much used to offering accounts and any even basic services around that, if we were to think that the central bank opens accounts for everyone, then of course the money in those accounts would be the risk-free central bank money asset as opposed to the commercial bank money asset. And that might not be an issue in good times, but it could be a real sort of bonus in bad times in the sense that this is a safe haven and therefore people may drain their bank accounts and hold their assets in central bank money directly. So all the discussions around macroeconomics, monetary policy, narrow banking, how would you also then as a central bank take the liberty to pass on negative interest rates if people would be holding their money instead of physical cash under their bed sheets in central bank digital currency? All of these questions are coming up, and what we've seen from China is, of course, a very coherent approach with a very coherent logic behind it, which may not be the logic and objective pursued maybe by the Western world. I mean, particularly around the civic implications and particularly there, I think about data privacy, privacy as to your transactions. You don't want everyone to know what you're paying for. Of course, if you pay for a house or an expensive good, that has to be, clear to make sure that we have clarity on source of funds and what you're really purchasing. But for your smaller purchases in a day-to-day context, you don't want people snooping into this. And so therefore, that is a very different model there where it's all about programmable and traceable money and traceable transactions and the ability of the central bank to freeze and stop at their wish, whilst of course in Europe we would be looking at more privacy, and that's why my idea at the time was, why don't we enable this for low value transactions where we have limits in terms of the programmable coding into it, and therefore we would also ensure immediate compliance with anti-money laundering rules because people wouldn't be using it for large amounts. So these sort of human data privacy aspects are really important. And I mean, I've been sort of privy to some thinking of the Bank of England even as of recent with some of the academics and the central bank around the table. And really, there's no immediate wish to go down that path. This has to be incredibly carefully considered. And of course, as a central bank here and the European Central Bank and central banks in other sort of developed countries, the approach shouldn't be too dissimilar because we may also want to look at, cross-border interoperability of some sort, maybe recreating a more immediate FX market with more efficiency. So I think there's a lot of benefit to create more transparency and efficiency down the line, but we're very far away from even thinking about how that could be realized.
And Naz, I know that you said that you had something you'd like to share as well.
Yes, I mean, I've been discussing CBDC at the IMF's high-level advisory group, and this has been a topic of conversation at that group for the past few years. I mean, with Christine Lagarde as the chairman of that group, and specifically as part of that group, we have Mu Changchun, which is the deputy governor from the People's Bank of China, who is considered the architect of the CBDC project in China. I mean, there are still far too many open issues. I do not think it is the right thing for central banks to provide retail bank accounts for each and every person. I don't think that model will be the future model of a CBDC, principally because it disintermediates the commercial banking sector. And whereas a central bank or people from the central bank may say that they're not responsible for business models of commercial banks, they are responsible for financial stability. And you can't let suddenly all these commercial banks be disintermediated from the process of manufacturing money, which is what they principally do through deposits and lending, right? And that's what would happen if you held the central bank held bank accounts at the central bank. The big issue with central bank digital currency, which is still not really being addressed, is the cost of implementation. China is unique; its payments infrastructure is already digital. Right? Who is going to pay for all the devices to accept digital currency at all the retailers, at stores, at service providers all across countries such as the UK, be it that the UK is more digitalized when it comes to payments, but look at Germany. Less than 50% of people in Germany own a credit card, right? Stores don't like using credit cards. They don't have that infrastructure. The question here is, who is the cost going to be shifted, right? Right now, the cost of manufacturing and managing cash is done by is attributed to governments and to the central bank, right? In a digital infrastructure, that payment means that there's no cost to us as retailers to use cash. But in a digital model, as it is now, I mean, there are payment fees, right, for using the technology that enables those payments. Who's going to pay for that? It would seem rather unfair if that cost is pushed down to merchants or to us as retail customers, right? And then you need to look at the cost of implementation, software, design, infrastructure, and critically, cybersecurity. This is as yet unscoped. I mean, China's not letting on as to how much it's costing them to do any of this. I think the most information we'll get on this is coming out of Sweden from the Swedish central bank. But can you even fathom the cost of changing and switching over that infrastructure? I think cash is here to stay for quite a long time, particularly in Western economies, particularly within Europe. Christine Lagarde is an incredible fan of blockchain. She was at the IMF. She talked about it with great gusto and always was looking at central bank digital currencies. When she came in at the European Central Bank, it was pretty much going to be obvious to me that she would be looking to push this direction. But how long before it actually happens? I can't see it before 5 to 10 years.
I feel like we could keep going on this for forever, especially if my co-host Ajit had been on this show, as we all know how much Ajit loves to discuss this. But to perhaps end on a very happy note, there's been some great news here in the UK recently. Anne Bowden, the founder and CEO of Sterling Bank, shared last week that the bank is now profitable. And last week, PensionBee shared news that they are seeking a potential listing on the London Stock Exchange at a valuation of £300 million. First of all, a massive shout out to these female-founded businesses. It's wonderful to see. But I think a broader question that I've been pondering is this a sign of a maturing fintech ecosystem? And I was curious for your thoughts. Perhaps I'll start with you, Ruth, as you stated you formerly sat on the board of the LSE. So curious for your thoughts.
Yes, I think it is. And I think if you look at the types of businesses that are starting to be profitable, and how they're being led, it always comes down to, to the actual vision of the founder and the team. I personally don't endorse this ever ongoing discussion about growth, but profitability, no, we don't care about. And we've seen that in some situations, this really didn't help, and whilst other businesses that are really big but still not profitable may have a bit of a credit in the market, everyone at some point should become profitable. And certainly from an institutional investor perspective, and that's something we discuss time and time again at the LSE market training sessions and conferences, is really that the real investors would like to see profitability because it's a sign of running your business well. And therefore, I'm really proud of Anne, what she's achieved. And personally, I think it's brilliant to see more female founders of fintechs, whether these are pure technology firms or more specific financial services. I think it'll take time. And when we know it takes time to build something solid, particularly if you go into banking rather than just fintech, This takes time. It creates a customer base. And also we've seen with COVID, it has to withstand some of those shocks. And it's really now a good proof in the pudding of the pudding to see which businesses are withstanding the shock well, which have planned well. I've seen a lot of frenzy also with my venture capital hat on over the summer that everyone suddenly wanted to do another funding round because everyone got really concerned that they may not have enough runway. But if you approach this sort of with a cooler head, at some point things work out, and I think we're starting people to calm down. So I'm very, very proud of that, and we will see more, but it will take time.
I think it was Warren Buffett who said, "Only when the tide goes out do you see who was swimming naked."
Exactly. You see them in their bathrobes, right?
Exactly. Leda, I know that you had some thoughts on this as well.
I do, and it's essentially picking out one thing Ruth said and sort of screaming it out loud. Well done to these businesses, but actually this is the name of the game. This is not a sign of maturity. This is not a signal that if you wait it out long enough and burn enough VC money, you will also make it. I don't think the fact that some businesses make it is an indication for everyone else to keep going. I think what Ruth said is right on the money, that for many organizations, and this is a collective fault of the ecosystem, growth and VC capital-based growth has been a measure of success for way too long. And you guys have heard me say this a million times before. I know we agree. I want to see sticky revenue. I want to see business viability. So what Ruth says is 100% on the money. But I want to say that it doesn't necessarily translate to a wider maturity. What I hope it does is it reminds all of us who have our own roles in this ecosystem that it's both possible and preferable, and creates a certain degree of sobriety in what comes next. Because what PensionBee is about to do is huge, right? A lot of businesses can succeed without getting there. What Anne proved is that you can't become a profitable bank overnight. It takes time. So both of those things show the scale of ambition and the amount of work that has to go in it. And I think that's a very important lesson for all of us to take away. We have seen a lot of initiatives killed a bit too early. But secondly, and most significantly, these were businesses that from the get-go had a business plan. Whether they needed to pivot, whether they needed to adjust, profitability was always on the horizon, and they had done the math on how to get there. And of course, it was a non-linear path, because it always is. But if you look at a lot of the entities that Ruth was too polite to mention, there isn't necessarily a plan other than an exit. So I think what this is not necessarily a fintech coming of age. Sorry to kill the happiness of the last story. It's a reminder of the hard work it does take for some fintechs to come of age, and maybe a food for thought moment for the rest of us as cheerleaders and investors to say, actually, it should be a metric of success. When you put your money and effort into those businesses, if there isn't a plan, you're part of the problem.
Yeah, and I think a big thing as well, having read the blog post by Anne, a big part of it is rolling with the punches. And we saw, dealt this specific hand, how Starling was distributing the bounce back loans. And so really going with the flow and adapting quite quickly and building a business that's able to adapt. Well, on that note, I want to thank you all so much for joining me today. I feel like we could go on and on and on, and I look forward to when we can do this in person again soon. But until that time, I would love for you to share, please, where our listeners can find out more about you, perhaps Ruth, starting with you.
Yeah, you can just look at my website, rwandhofer.com, or just Google me or find me on LinkedIn. It's the easiest. Love to connect with everyone.
And Leda, where can our listeners find out more about you?
At Leda Glyptis on Twitter, on LinkedIn, and on FinTech Futures every Thursday.
And a massive congratulations on your new role.
Thank you very much.
And last but not least, Naz, where can our listeners find out more about you?
Sure, you can go to our website, LHoFT.com. You can download our app, which is officially launching in the next 2 weeks, which is like a news aggregator, shows what's going on in the Luxembourg community and beyond. So LHoFT News on either Google Play or Apple Play or the Apple iTunes Store. And you can obviously follow me on social media, NASZUB, NASZUB on Twitter and most other channels.
Amazing. And as always, don't forget to subscribe and leave us a review and comments. We love to hear from you. And stay tuned for the next episode of Breaking Banks Europe.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with FinTech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.